Different investors choose different techniques for picking shares. Here we're going to look at some of these methods. When professional investors want to choose shares, they rely on a combination of strategies. These may be based on a mixture of trend following, technical analysis, fundamental analysis, momentum investing, contrarian investing, etc. Each investor has his or her own favorite techniques or uses a method based on personal experience. The purpose of this video is to show you some of these techniques. You can then decide if you'd like to study one or more in detail. To master a technique, you need to learn it through a specialized book, as the subjects are far too large to cover here. You should not just rely on one technique. The more data you use and the more you read about the shares you're tracking, the better your decisions will be. We're going to look at the following 6 different techniques. Trend following. This is spotting trends in shares and following them. Following the trend and exiting when the trend is interrupted. Buying high to sell higher and selling low to buy back lower. Valuation investing. This is studying the relative cheapness of a share by comparing it with others. Buying on the basis that over time the valuation of the share will change to correct any mispricing relative to peers. Peers means other shares in the same sector doing a similar business. Momentum investing. This is about spotting and following market momentum. This is somewhat similar to trend following, but uses different metrics. It buys winners and sells losers, riding the wave of market strength. Fundamental analysis. This is studying the company accounts, performance, industry conditions, risks, competitive landscape, the economy, and investing for the long term. Technical analysis. It follows an analytical method to forecast future price movements by studying past price and trading volume data to identify known patterns and price formations. Contrarian investing. This is following one's own vision for the future of the economy and the world and different sectors. Totally personal, knowledge-based. Trend following cashes in on the momentum of a share's price movement. Investors using this strategy believe that shares that have been trending in a certain direction, up or down, will continue doing so for longer. You hear or read the following terminology in the financial news all the time, so important to know what they mean. Uptrend. This means that a share price keeps moving higher, marked by higher highs and higher lows. Downtrend. This means that a share's price keeps moving lower, marked by lower highs and lower lows. Sideways trend or range bound. This is when the share price fluctuates within a price range without a clear upward or downward direction. Trend followers use several tools to identify the direction of the market. Moving averages is one of them. There can be the simple moving average, or SMA, or an exponential moving average, which is called EMA. When a shorter-term moving average crosses a longer-term one, for example, 50-day moving average crosses a 200-day moving average, is seen as a bullish or buy signal. A 50-day moving average means a curve that averages the share price over the past 50 days. An exponential average also averages the share price over the same period of time, but it gives greater weight to recent prices and lower weight to older prices, so it can pick up recent moves more quickly. Please look up SMA and EMA on the web. There's just not enough space here to cover it. Trend lines. This is little more than drawing lines along the share price peaks and troughs to spot patterns, but there are more complex techniques available. Moving average convergence divergence, or MACD. A momentum oscillator that helps traders identify the strength and direction of trends. Please check this on the web. Let's look at some trends. We start with an uptrend with 20 days simple moving average or SMA. The blue line shows the simple moving average, and the data for the share price has been generated randomly. Note that the blue line starts off the left edge of the chart because you need 20 days of share price data before you can actually calculate an SMA. Note also the blue hazy band around the simple moving average. This is referred to as the Bollinger Band. It shows plus minus 2 standard deviations statistically how much the share price was expected to move around the simple moving average based on the data that went before it. This is something you can read up about in the literature. The good news is that many financial websites show both the SMA and the Bollinger Band for free. This graph shows a downtrend, again with 20 days simple moving average. It has similar characteristics, but note that the Bollinger Band is narrower, and the reason for that is that the share price is somewhat resolutely going down and down and down and down. So there's not too much variability around the trend down. This chart tries to show how the EMA reacts more quickly to changes in trend. The EMA and SMA are both calculated over 50 days. The SMA is shown in blue and the EMA is shown in orange. If you carefully look at the chart, you'll see, for example, starting from the middle where you see the high peak, you see that EMA reacts and moves up more than the SMA does. And a little later, about 3/4 of the way through, when the share price drops reasonably substantially, the EMA follows it more clearly than the SMA does. This is the advantage gained by weighting the most recent share prices more than the older ones. Now we look at the second style of investing, which is valuation investing. This involves identifying shares that are undervalued relative to their true worth by analyzing key financial metrics like price to earnings or PE ratios and dividend yields. PE is just a normalized way of showing how high a company's price is. Value investors compare these metrics against industry peers to find companies trading at a discount, believing that the market will eventually recognize their true value and correct the price discrepancy, resulting in potential gains for the investor. The risk in valuation investing is comparing a company to peers with a different business model. This can lead to quite misleading conclusions. Whilst this is a powerful tool, it must be applied within the right context and framework to be effective. Let's look at some valuation metric fundamentals. We already discussed price to earnings or PE ratio, which is one of the most widely used valuation metrics. It compares the company's current share price divided by its earnings per share with that for other shares in the same sector. A lower PE ratio often indicates that a share is undervalued relative to other shares in its sector. Price to book or PB ratio compares the company's market value with its book value, that is, total assets minus total liabilities. A PB ratio under 1 may signal undervaluation. The book value is a measure of what the company would be worth if it were split up into components and sold off. Price to sales ratio is a ratio that looks at a company's market value relative to its sales. It's often used for companies that don't yet make a profit but are expected to do so in the future, so typically startups. Discounted cash flow, or DCF, is a method that attempts to estimate a company's value by forecasting future cash flows and discounting them to the present using a discount rate, which is often the company's weighted average cost of capital. If the DCF-based value is greater than the current market price, the share may be considered undervalued. To learn which metric to use for which type of company, you need to do some studying. There are many great books on the subject, typically with titles including the word valuation. Let's look at what valuation metrics look like. Here we have a comparison of the PE and dividend yields for 10 large oil and gas companies across the world. These are ranked from the lowest to the highest PE. Oil and gas companies operate upstream, that's exploration and production, downstream, which is refining and distribution, or may have an integrated model, which combines both upstream and downstream. It is important to also check the dividend yields, as this is an indication of the amount of cash the company is generating. Usually, lower PE companies tend to have stable business models and pay higher dividends to attract investors. Growing companies may have higher PE but pay lower dividends as they use cash to grow. Investors often invest in growing companies for share price appreciation. This does not seem to be the case with the last company in the table that has a high PE and pays a high dividend. When you come across such anomalies, explore the reasons. Always compare the PE and dividend yield of each share with the average for the sector and try to understand the reasons for any differences. Looking at the table in detail, you see that the lowest PE ratio comes with a dividend yield of 7.8%. As one moves down the table, the PEs increase and the dividend yields come down. But the last company has a PE ratio of 21 and a dividend yield of 5.7%. So you would need to know why. This could be that the market thinks that the company is on the verge of making a breakthrough of some sort, or etc. But you need to understand, it is extremely important when you're looking at valuation metrics to put them into the context of the sector the company is from. Next, we look at the PEs and dividend yields for 20 large pharmaceutical companies, which are shown on the table. These are ranked from the lowest to highest PEs. Pharmaceuticals may be involved in existing drug sales, developing new drugs, or often both businesses. This is a very high risk, high reward sector. Companies with large existing drugs portfolios generate large revenues and pay high dividends. Companies that are mainly developing new drugs invest their revenues in growth, so they may pay lower dividends, but they can have much higher PEs as investors hope that their new drugs will be successful and push up their share prices. Because of the uncertainties around the success of new drugs, the PEs can vary a lot and can also change very quickly. Investing in this sector needs a lot of reading and a good understanding of the business of each company. The likely success of new drugs pipelines and expiry of patents on existing drugs portfolios are important factors. Please take a moment to study the table and look at the PEs and dividend yields and the trend that you observe. Now we come to momentum investing. This follows the idea that shares that have performed well in the past will continue to perform well in the future, and that shares that have underperformed in the past will continue to do so in the future. This involves buying shares that are trending upwards and selling shares or shorting shares that are trending downwards. It's easy to see that this strategy can only be applied over relatively short periods of time, as companies adjust their businesses to improve profitability. A well-performing company may not do well forever, and an underperforming company may eventually improve. These ideas seem simple enough, but picking the shares and timing the trades is always difficult. Momentum investing is just following the market and often ignoring the fundamental economic and financial aspects, company strategy, etc. It carries risks and requires constant attention. The common momentum indicators are the Relative Strength Index or RSI. This measures the speed and change of price movements. An RSI value above 70 indicates that a share is overbought, while a value before 30 suggests that it's oversold. The formula is RSI equals to 100 minus 100 divided by 1 plus RS, where RS is the average gain over n periods divided by average loss over n periods. Typically, n is taken to be 14 days. Rate of change, or ROC. This measures the percentage change in the share price over a given period. A rising ROC suggests increasing momentum, while a falling ROC may signal a reducing momentum. ROC is calculated by tracking the increase or decrease in share price over a period of 10, 14, or 20 days. Then, moving average convergence divergence, or MACD. Even though it is often used for trend following, the MACD also provides insights into momentum. You may wish to study these topics in greater detail using dedicated books. Please look at the uptrend shown below, with green indicating up and red indicating down. When there are more greens than reds, and you can see this by just observation, this shows that the trend is upwards. The next style of investing is through fundamental analysis. A fundamental analysis means that you study the shares by analyzing the economic and financial factors that affect its performance. This is a long-term investment approach, focusing on the company's intrinsic value, competitive position in the market, and its overall financial health. This may seem simple enough, but picking the shares and timing the trade are difficult. Fundamental analysis requires a good knowledge of the related financial maths and accounting, which can all be gained through studying books on the subject or learning through work or via educational routes. This is a style of investment which is often associated with Warren Buffett. The key metrics of fundamental analysis are earnings growth. Analysts look for consistent earnings growth as an indicator of a company's potential. Revenue and profit margins. Healthy revenue growth and strong profit margins are excellent indicators. Debt levels. High debt-to-equity ratios can be worrying, as it may suggest financial weakness. Management quality. The expertise and track record of the company's leadership are also crucial for determining a company's long-term prospects. Industry and competitive position. A company's position within its industry, its competitive advantages, and its market share are vital for assessing its future prospects. Even a very well-managed company may not survive being badly positioned in the market. This style of investing needs a lot of knowledge and analysis. Another style of investing is technical analysis. Technical analysis is used to forecast the future price movements of securities such as shares by analyzing past market data, mainly price and trading volume. Unlike fundamental analysis, which focuses on a company's financial health and intrinsic value, technical analysis is based on the belief that all known information is already reflected in a share's price. Analysts use charts and various indicators such as moving averages, relative strength index, and MACD to identify patterns and trends that suggest potential price directions. The core assumption behind technical analysis is that market prices move in trends and that history tends to repeat itself due to a consistent market psychology. Traders use chart patterns like head and shoulders, triangles, and support resistance levels to make informed trading decisions. While something that it lacks predictive power, many traders use technical analysis in combination with other tools to manage risk and improve timing in both short-term and medium-term strategies. To learn more about technical analysis, you need to study a dedicated book. It's a very wide subject. The key metrics of technical analysis are moving averages, which is used to smooth price data to identify trends over a specific time period. The 50-day and 200-day moving averages are particularly common for identifying longer-term trends. Bollinger Bands. These bands expand or contract based on the volatility of a share price. Prices that touch or break through the bands can be interpreted as overbought or oversold. Support and resistance levels. These are horizontal lines that represent price levels where a share tends to stop and reverse its direction. Support levels act as a floor for the share price, while resistance levels act as a ceiling. Candlestick patterns. Specific patterns like doji, hammer, and engulfing can signal potential reversals or continuation of trends. Share trading volume. Volumes used to confirm trends. An increase in volume indicates strength behind the move, while low volume suggests a lack of conviction. Again, to understand all these terms and to come to grips with all the details, you would need to study technical analysis in much greater depth. Here we show 50 and 200 day simple moving averages superimposed on a randomly generated stock price chart. The 50-day average is shown in blue and the 200-day average is shown in orange. Many traders believe that when the 50 days crosses through the 200-day average on the way up, that it could be a buy signal. Some believe this and some are more hesitant. Please pause the video for a moment, have a careful look and see what you think. Now we come to contrarian investing. This is built around a simple idea. Go against prevailing market sentiment to find opportunities that others overlook or avoid. Many investors follow trends and crowd psychology, but contrarians believe that markets often overreact and emotions create mispriced assets that offer long-term potential if traded at the right time. Contrarian investing is not about being different, it's about being right when others are wrong. This requires a unique mindset, deep knowledge of the economy, geopolitics, continuous research, and emotional resilience. When good news floods the markets, investors often become overly optimistic and drive prices up. During downturns, pessimism can become irrational, pushing prices too far down. Contrarian investors capitalize on these emotional mispricings by sticking to their convictions when others think they're crazy. Warren Buffett has a famous quote, "Be fearful when others are greedy and greedy when others are fearful." Contrarian investors believe that by avoiding the herd mentality, one can identify hidden value and long-term opportunities. Let's look at some contrarian investing examples. The first is buying during the 2008 financial crisis, when banks, real estate, and automakers crashed. While panic led many to sell at a loss, contrarians like Warren Buffett bought into companies like Goldman Sachs and Bank of America at depressed prices. These positions later produced substantial returns. 2. Tech stocks in the early 2000s. After the dot-com bubble burst in 2000, tech stocks went out of favor, but contrarian investors who bought companies like Amazon or Apple when they were deeply undervalued made massive gains over the following decade. 3. Airlines during the COVID-19 crash. When the COVID pandemic hit in 2020, airline stocks collapsed. Whilst everyone was selling, contrarians who believe in a post-pandemic recovery bought airlines at a fraction of their pre-pandemic prices. We've looked at a lot of methods that are used by traders to buy securities, especially shares. Each method has its strengths and weaknesses. Successful investors usually use a combination of strategies or their own methods. Each strategy needs to be learnt in detail, preferably from dedicated books. This can take a lot of time and requires dedication. Some strategies are easier than others. No matter which methods used, understanding the principle, benefits and shortcomings of each method is critical to making good decisions with it. Balancing multiple factors, risk management, and adaptability to market conditions are key to long-term investing success. It's not mandatory to use any of these methods. Many successful investors follow their own strategies developed over time. Nevertheless, all investing requires learning, reading, and keeping up to date with the markets. Picking shares is not like picking flowers. It's a matter of spending time reading and analyzing. Imagine being asked to pick the 5 flowers that are going to last a week.